Hi, Group B here, TACC605 Corporate Accounting. Thank you for joining us today. Our presentations focus on the case study of Aqua Bread Limited, especially examining how the company should account for the various provisions and liability in accordance with AASB 137. We are five members on our crew and we will address five main areas. For each topic, we will explain the relevant accounting treatments, journal entries, and disclosure requirements, supported by its appropriate standard and professional judgments. Our goal is to provide a clear and practical understanding of how Equabread Limited should recognize, measures, and report these items in its financial statements. So let's begin with our first topic.
Thank you, Asmita. The topics of this presentation are product warranty provision, environmental liability, pending litigation, restructuring provision, and general provisions and contingent liabilities. The first topic of this presentation is product warranty provisions. Product warranty provisions means that the company have specific terms and conditions which includes the warranty policy outlining the rights and responsibilities of buyers and sellers in terms of repair, replacement or refund of the product that fails to meet specific standard performance within a certain time frame. The key points in product warranty provisions are: products are covered under the warranty, states how long the warranty is valid from the purchase date, and remedies offered which the manufacturer will do if the product is defective, such as repair, replacement, or refund. And consumer responsibilities lists what the buyer must do to claim the warranty. Product warranty provisions under recognition and measurement under AASB 137. Aquabright Limited must recognize a provision for product warranties under AASB 137 provisions, contingent liabilities and contingent assets, which requires an entity to recognize a provision when Aquabright has a legal obligation under the warranty. Historical data 5% failure rate, $100 cost unit provides a reliable estimate. This meets the criteria for recognizing a provision. In Aquabright situation, selling water filtration system was a 1-year warranty results in a constructive obligation based on the previous failure rate 5%. It is likely that certain system will not to be repaired or replaced. Previous data can be used to reliably measure the obligation. The expected cost of warranty is calculated as follows. Let's assume Aquabright sells 1000 units in a year. 5% of 1000 units is 500 units likely to be repaired or replaced, and then average cost per unit is $100. Total provision will be 500 into $100 into $50,000. And the journal entry at the end of the year is: this provision must be recognized in the same period as the related sales in line with the matching principle. Journal entry at the end year: debit warranty expenses $50,000, credit provision for warranty $50,000. Thank you so much.
Asmita here, and in this presentation I will explain how Aqua Breed Limited should account for its environmental liability following a recent incident involving the chemical discharge. We will apply the relevant criteria under AASB 137 to determine whether a provision must be recognized, how much should be recorded, and what consideration must be taken into account. The company operates near a river have led to environmental incidents, that is, chemicals were accidentally released. To avoid the legal penalties and comply with the environmental regulations, Aquabrid must clean up the site, which is estimated to cost $5 million. This created a potential financial obligation requiring accounting considerations under AASB 137, And requirements when to recognize a provision. AASB 137 outlined the three essential conditions for recognizing a provision. First, a present obligation exists due to the chemical discharge. Second is probable that the company will incur the cleanup cost. And third, the cost is reliably estimable. Therefore, the equabrate must recognize a provision, and in this case, all those three conditions were clearly met. The appropriate accounting treatment is to recognize the $5 million provision as a liability and an equivalent expenses. This reflects the probable outflow of economic benefits. Recording it properly ensures the transparency and compliance with AASB 137. In estimating the provisions, Equabrid must evaluate the various factors such as the level of environmental damage, the legal compliance cost, and the advice from the specialist. If the cleanup extends over time, the amount may need to be discounted to present value. In conclusion, Equabrit must record a provisions of the environmental liability. This ensures the faithful representations of obligations in its financial statements and compliance with AASB 137. The company should ensure the estimate is well supported and adequately disclosed to stakeholders.
Recognition of a restructuring provision. Under AASB 137, a provision for restructuring should be recognized only when all of the following conditions are met, like a present obligation exists as a result of a past event. It is probable that an outflow of resources, that money, will be required to settle the obligation. The amount of the obligation can be estimated reliably. Application to Equabyte Limited. Equabyte Limited meets the recognition criteria for a restructuring provision as follows. The company has made a formal decision to restructure its operation and has created a detailed plan. This restructuring plan was communicated to the affected employees before the end of the financial year, creating a valid constructive obligation. The company is able to reliably estimate the cost involved in the restructure, which amounts to $3 lakh in severance payments. Disclosure requirements for the provision. Once the provision is recognized, AASB 137 requires the company to provide clear and comprehensive disclosure in its financial statements. The key disclosure elements include the amount recognized as a provision, a description of the nature of the obligation, the expected timing of the associated cash flows, uncertainties if any related to the amount of timing of the outflows, any expected reimbursement if applicable. Disclosure example: Equabyte Limited restructuring provision. Equabyte Limited has recognized a provision of $3 lakh in relation to a planned restructuring of its operation, especially relating to severance payments for employees. A detailed restructuring plan was formulated and communicated to all affected employees prior to the end of the financial year, establishing a constructive obligation. The company does not expect any reimbursement and there is no significant uncertainty regarding the estimate. Thank you.
Hello everyone. Today I will be discussing how Equabright Limited should account for contingent liabilities related to a pending lawsuit in accordance with AASB 137, which governs provision, contingent liabilities, and contingent assets. Let's go with the background. Equabright is currently facing a legal case where a participant is claiming patent infringement. The company's legal term has assessed a 60% probability of losing with an estimated financial impact of 200,000. This situation brings up an important question. Should this potential loss be recognized? in the financial statement are just disclosed. We're going to talk about the scenario, and under AASB 137, a provision must be recognized when three conditions are met. Number one, there is a present obligations from the past event. Number two, there is a possible that an outflow of resources will be required. And the number three is the amount can be reliable estimated. In this case, a legal obligations exist due to the lawsuit. There is a 60% chance of losing, which is above the probable threshold of 50%. The loss amount of 200,000 is reliable estimate. Therefore, all criteria for recognizing of provisions are met. Now we're going to talk about the impact of outcome probability on recognition and measurement. AASB 137 clearly distinguishes between different types of probability. If the chances of lose is 50%, which is probable, then a provision should be recorded. If it is possible but not probable, around 20 to 50%, then it should only be disclosed in the note. And if the chance is remote, below 20%, then no action is required. Since the probability here is 60%, Aqua Bright falls into the first category and must record the liability. Now we're going to talk about the financial statement impact. As a result, Aqua Bright should recognize a 200,000 provision in the statement of financial position and include details in the note such as the nature of the lawsuits, the timing of potential outflow, and any uncertainties. The appropriate journal entry will be debit legal expenses 200,000 and the credit provision for litigations 200,000. To conclude, by recognizing this provision, Aquabright is complying with AASB 137 and ensuring that its financial statements present a true and fair view of potential liabilities. It also helps stakeholders understand the financial implications of ongoing legal proceedings.
Thank you, my dear friend. Now I would like to continue with the presentation slide of general provision and contingent liabilities. General provision, it is a liability, but the amount is uncertain. So the company records it when it has a present obligation, either because of the legal or constructive reasons arising from the past events, and there is a certain that the outflow of resources will happen in the future. The contingent liability, it is not a present obligation, it is just a possible obligation that arises from the past events, and it will be confirmed only after the occurrence or the non-occurrence of certain future uncertain events that are wholly not within the control of the company. Now continuing with the criteria to recognize a provision as per AASB 137, Aquabright Limited must meet the following criteria to recognize it as a provision. There must be a present obligation in order for the Aquabright Limited to record a provision. There must be more than 50% of the likelihood that the probable outflow of resources will occur, and the amount of the obligation can be reliably estimated by the company. Then only the Aquabright Limited can recognize it as a provision. Otherwise, the company should record it as a contingent liability in the notes to accounts, which is shown as per the disclosure of contingent liability slides. The first, the probable of outflow of resources is not certain. If it is not probable that the outflow of resources will be required to settle the obligation, the liability is contingent, and if the contingent liability is material, it must be disclosed. However, it is very remote, then the disclosure is not required. And the disclosure of contingent liabilities needs the nature of the liability must be disclosed, the possible financial effect of the liability should be disclosed, and any uncertainties about the amount or timing of the potential outflow. If the criteria are not met, Aquabright Limited should not recognize its contingent liabilities in the financial statements, and it should not even have to mention it in the notes to accounts. Thank you very much.